Welcome to the Wall Street Wish List, an investment shopping list from seasoned analysts. And each of the analysts featured today are from Noble Capital Markets, an SEC-registered, FINRA-licensed broker-dealer. Before I introduce the analysts, I want to remind you that this program is provided for informational purposes only, and none of the content should be interpreted as a recommendation or solicitation to buy or sell securities. Investment decisions must be made by you or with the support of your financial advisor. A complete disclosure statement follows each analyst presentation. Let's get going. Michael Heim is a senior equity analyst focusing on energy, utility, shipping, and logistics stocks with more than 25 years of experience. An MBA holding chartered financial analyst, Michael is a 4-time winner of Wall Street Journal's Best on the Street and a 3-time winner of Forbes' Best Brokerage Analyst. Welcome, Michael Heim.
Happy holidays to everybody. My name is Mike Heim, and I'm the energy and shipping analyst for Noble Capital Markets. Now, energy and shipping may seem like two industries that are not related, but there is a connection. Both of them are very cyclical businesses. They're industries where companies will overproduce in terms of building new ships or overdrill, and that will sometimes causes pricing to go down. And then we'll go through a period where they're underbuilt or underdrilled and prices go back up. As we are sitting right now, we have seen oil prices that had peaked up near 120 down to around 75, still very good relative to long-term historical perspectives, but they have come down a bit. Same can be said for shipping rates. That at one point we had TCE rates that were above 30,000 a day, and now we're closer to under 15,000. Now, predicting the length or the severity of cycles is always very, very difficult. And I don't want to spend a lot of time, trying to do that. I think where I, as an analyst, can add the most value is knowing companies individually and knowing which ones are protected against the changes in pricing, or maybe ones that aren't protected but have been hit a little bit harder than we think they should have been. So what I'm going to do over the next several minutes is talk about a handful of names that fit various categories, whether we think they've been unfairly punished, or maybe they are in a good position that they shouldn't be punished at all. I'm going to start out with talking about the category of our favorite pick for stocks that are over 500 million market cap. And my pick for this group is a company called Genco Shipping Holdings. Symbol is GNK. It's got a market cap of about 620 million. We have a price target of about 28. Genco is a US-based dry bulk ship owner focused on the seaborne transportation of commodities globally. It uses a portfolio approach towards revenue generation through a combination of short-term spot market employment and longer-term bookings. Genco has 44 modern vessels, and the focus is on providing full service to its clients. And because of that, it tends to receive premium prices versus other shipping companies. More importantly, it's fixed about 75% of its operating days. So even as we talk about shipping rates coming down, it's a little bit better protected than most of its peers from lower shipping rates. And the result has been that it has very strong cash flow, which it's been using to pay down debt and return proceeds to shareholders through a dividend policy. And because of it, we think that it's a very good investment at this point. The next company I'm going to talk about is my favorite pick, under 500 million market cap. And this is an energy company called InPlay Oil Corporation. The symbol on the US OTC exchange is IPOOF. That's a market cap of about 185 million. We have a price target of $6 per share. InPlay is a light oil producer, exploration production company operating in Western Canada. Despite the recent drop in oil prices, operations remain very profitable for the company. Newly drilled wells have a very attractive payback period. Not as good as it was when oil prices were 120 and they could get a payback period of 2 to 3 months, but we're still able to return the cost of drilling a new well within 1 year. And that number is getting better as the company continues to find new efficiencies in terms of drilling and both operating. And that leads to higher profitability and very strong cash flow. The company has been reducing debt over the last several years. It began a share repurchase program just this summer, and just in the last month, it's announced its first dividend. So the fact that they're able to pay a dividend even at a lower price, we think speaks to the sustainability of that dividend, and the fact that the company is still generating a lot of excess cash flow and feels the importance of returning some of that to shareholders. Moving on to the next category, I'd like to talk about a company named Alvopetro. This is another energy company that is kicking off a lot of excess free cash flow, just like I was talking about with InPlay, but maybe even in a better financial position. Alvopetro is Alvopetro, symbol ALVOF, has 185 million or so market cap, and we have a price target of $10 per share. It's an energy exploration and production company operating in Brazil. The interesting thing about Alvopetro is that the price it receives, and it's mainly natural gas production, the price it receives for natural gas is based on a formula that's tied to oil prices, natural gas prices, and the real exchange rate with the dollar. The price is reset 2 times a year, every 6 months. It does have some limits, ceilings, and floors in terms of how it is adjusted, and lately it's been capped out at a ceiling. The price that the company receives right now is about $11 an MCF for the gas it sells. If there had not been a cap, it would be closer to $15. So if we talk about natural gas prices or oil prices or any of the mechanisms that set the price they receive, as we talk about those coming down, keep in mind that we're still not receiving anywhere near what we would be if the caps were in place. Alvopetro is expanding its production. It's been doing this over the last several years. It processes the gas through a processing plant that was just recently expanded this summer. It does have designs on further expansions, both in terms of the processing plant and the drilling. In fact, management talks about a long-term goal of doubling production. That'll depend a lot on the success of some of these wells that they're drilling out, but we think as a long-term goal, that's very achievable. Let me move on to the next category, which is stocks that have very low debt and really no near-term financing needs. I'm going to talk about a little bit different company here. This one's called Kandi Technology Group. And this is a company that has a very large position and really no need to raise capital in the immediate future. Symbol on Kandi is KNDI, got a market cap of about $200 million, and we have a price target of $5 per share. As I mentioned, it has a very large cash position. The company has working capital in excess of $250 million, which works out to be almost $3 per share. And this is for a company that's currently trading at about $2.70 a share, even though the company has no debt. Kandi is a Chinese company. It's a manufacturer of electrical vehicles, not so much cars, but things such as electric golf carts, go-karts, ATVs, that type of stuff. They also are involved in supplying batteries and parts to these vehicles as well. And it's sold not only in China, but in the United States as well. Fair question to ask would be, why is the company not more active repurchasing shares if they have that much cash and the stock is trading at such a low level? And they are repurchasing shares, but in the end, this is a technology company. They do feel it's important to keep a good cash position, and they do spend a lot of money on R&D each year. But we do think that because they have a share purchase, because they have this large asset base, that there is some protection against further weakness in the stock. So we think that's a good one to keep an eye on. Moving on, let me talk a little bit about another shipping company. This one's called EGLE Bulk Shipping Company. And this is a good example of a company that is pretty well protected against the down cycle, and we think can grow even in this type of lower shipping rate environment. Symbol on EGLE is EGLE. It's got a market cap of about $690 million. We have a price target of 84 on the stock. It's a fully integrated US-based operator and owner of shipping vessels involved in the dry bulk commodity market. Like many of the other shipping companies, it's done a very good job of paying down its debt and modernizing its fleets during the upcycle. And that's really put it in a good position to weather, what we think could be a temporary situation with low shipping rates. We think the company is poised to expand. We wouldn't be surprised if they pick up more vessels during the down cycle here. And then when we do get back to an upcycle, which we do believe could happen in the next year or two, we think they could, they're in a good position to really expand operations. Moving on to another company, let me talk about one that has really been hit a little bit more than we think it should. And this is another shipping company, EuroDry Ltd. To be honest, EuroDry does have a lot more sensitivity to shipping rates than most, and that's probably why it's been hit. Oh, I should say EuroDry symbol is EDRY. It has a market cap of about 46 million. We have a price target of 35. It's a provider of worldwide ocean-going transportation services. The shares are trading at only about 40% of the peak price it hit last spring when we were in the upcycle. It is a little more sensitivity to rates than others, and that's why it's probably been hit more. So a lot of the bet we have with EuroDry is that this is going to be a short-term temporary down cycle in the shipping industry. When you think about why shipping rates have gone down, you usually point to things such as China has been locking up a little bit in a COVID preventive manner. Of course, the conflict in Ukraine has disrupted grain shipping and shipping of other dry goods. And but at the same time, we're going through a period where shipbuilding is still relatively low, and they're going to be retiring other ships. So we think, this will be less than a 12-month down cycle. So companies like EuroDry that have been hit very hard really could do well when we start getting into a better economic situation for the industry. Moving on to the next company. This is a company called Energy Fuels. It's traditionally been a uranium mining and production company. This is a good example of a company that I think has some very good near-term catalysts which could propel the stock higher. Symbol on Energy Fuels is UUUU, and the market cap is about 950 million. We have a $13 price objective on the stock. It really is, as I mentioned, the leading producer of uranium and vanadium, as well as an emerging player in the commercial rare earth elements business. And I'll talk about that a little bit later. But let me talk first about the uranium business. Much of the uranium that's produced in the world comes from Kazakhstan and Russia. The US has traditionally been a big producer, but in the last really a dozen years or so, production has been curtailed. And that's because the pricing just hasn't been there. As we start to worry about global conflicts, sourcing of uranium, there is increased interest in getting US production back up to speed. And that's a story that's kind of been out there for 5 years or so. But recently we're starting to see signs that the uranium industry domestically is starting to pick up. Companies like Energy Fuels have started signing contracts with utilities, nuclear utilities, to provide uranium. And we're finally at a point where companies like Energy Fuel are starting to start up production again. And we expect to see sales of uranium next year, which is definitely a positive development. As far as the rare earth elements go, these are a series of highly magnetic metals that are used in electrical operations, batteries, that type of stuff, and expected to really be in high demand as renewable energy increases. It's mainly been done overseas in China, and Energy Fuels is planning on being one of the first ones to really get rare earth element production going. They have started some operations. At this point, it's basically separating concentrations concentrates of rare earth elements. Going forward, they're talking about equipping their mine to be able to do complete separation of both heavy and light rare earth elements. And we think that could really be a big game changer for the company. So near-term catalyst of get uranium sales going, so we start to get some money coming into the firm. 2 to 3 year catalyst of developing these rare earth elements. Both of events we think are very possible and will be good for the stock for energy fuels. Finally, I want to close with one more company that I think is very interesting, and this is really a company that I think provides the best example of a positive return versus the risk profile. And this is a company called Permex Petroleum Corporation. Symbol is OILCD, market cap of about 5 million. We have a price target of $40, which is more than 10 times what the stock is. And let me explain that a little bit. This is a company that tries to buy energy assets during the down cycle, exploit them during the up cycle. And that's exactly what they did. They made a large acquisition about 2 years ago when energy prices were lower, and they're just now starting to drill out the property. The eye-grabbing thing with this stock is that they have an independent study of their reserves that estimates a present value at a 10% discount rate of all the reserves that would value their assets at $287 million. Now, the company has no debt, and the market cap is, as I said, about $5 million. That's a large disparity. You know, how can a company be, trading at only 5% of what its assets are worth? Well, the answer is they've got to go from having good assets in the ground to showing, to demonstrate that that can turn into cash. And they're right at the crux of starting to do the drilling. We're still waiting to hear on results from the first well that they're drilled, but very high upside with this one. Yes, there's risks. We have some financing risks associated with the company as their cash positions are getting low, but I do think this is a good example of what could be a very good return potential given the risk that you're taking. So that's one that we're definitely keeping a close eye on. I've gone over a lot of names, 8 names, one in each of the categories, and hopefully I've given you some names or ideas to think about as given whatever your individual investment strategy is. As always, you can find full reports or more information on any of these companies or any of the companies I follow in channelcheck.com, CHANNELCHEK. And if you have questions, please feel free to give me a call after that. My name and number and emails are all in the reports. With that, I'm going to stop there and turn it over for some questions.
Excellent. Thank you for that, Michael. So we have a few questions to go through today. The first question we have pertains to Genco shipping. And the question is, would you rather see Genco pay down debt or raise the dividend with its excess cash flow?
One of the important things to keep in mind with these cyclical businesses, you want to pay a dividend, but you want to make a dividend that's sustainable even if we get in the down cycle. So both paying down debt and increasing the dividend are important and good ways to support the stock and show that you're rewarding the shareholders for with your cash flow. But given that we're kind of entering a down cycle, I think it probably makes more sense to focus on paying down debt at this point.
All right. Our next question pertains to InPlay oil. And this is a two-parter. First, do you think oil prices will continue to fall? And second, do you think InPlay can continue to reduce drilling and operating costs?
One thing I should point out when we do our models and our valuation work, we don't base it on $120 when it gets up to $120. We don't even base it on $75. We're using a long-term oil price of $60. And I think we're starting to get towards what I would call a sustainable price. It's always hard to say whether it's $60 or $75. I could see a little more weakness in oil prices if we continue to see global economic weakness like we have, but I don't think we'll be talking about numbers below $60. And that means for companies like EnPlay that can produce the oil at $20 a barrel, that these high returns are definitely going to continue. As far as continuing to reduce costs and both drilling and operating costs, the industry has gone through a period where we had some tremendous gains when we started implementing fracking and horizontal drilling to new structures. Over the last 10 to 15 years, it's been kind of a situation of fine tuning, what the exact amount of number of fracks or the sand that's used in the fracking or whatnot. And we continue to see some gains. It's getting a little bit tougher as time goes on, but InPlay continues to amaze me with the advances they continue to make, and they are still doing new techniques and different drilling. So I guess my quick answer would be yes, I expect continued improvements, although it may slow down just a little bit.
All right, next up we have one on Alvopetro, and the question is, what will it take, in your opinion, for Alvopetro to meet management's target of doubling production?
Well, I think I mentioned that they did everything needs to go through a processing plant, and they did just do a processing plant expansion. And they're now drilling wells that are getting the production levels up to that new processing plant expansion. The key to do something like doubling production, though, is really going to involve perhaps finding some new fields, and they're starting to drill some new and more exploratory wells out west and up north of where they are. And then if those are successful, the next step will be a major expansion of the processing plant. This is probably something we're not talking about for the next 2 to 5 years, and we don't really have a good cost estimate of what that would be, but those are the things to look at, how successful they are with their exploratory drilling, and that will probably lead to major expansions of the processing plant.
All right, next up we have a question on Kandi technology. And Kandi technology was making full-size vehicles like pickup trucks, which they've recently been de-emphasizing. Why do you believe they've been de-emphasizing the full-size electric vehicles?
The electric car and truck industry in China is very competitive right now. Other companies are operating at a loss just to try and establish market share, and Kandi's kind of found this nice niche in dealing with electric off-road vehicles that they can make a lot of, that are very profitable. That at this point, they'll keep their eyes on the electric vehicle market, but they're not going to get in there at the risk of losing a lot of money just to try and create a name for themselves.
Makes sense. We have a couple coming up here on the shipping companies. First up, EGLE Bulk Shipping. Is EGLE protected against a prolonged down cycle?
That's a fair question. I mentioned that they are, locked in a lot of the rates, but of course those fixed rates roll off over time. So are they protected over a prolonged cycle? I don't think any shipping company is, and I think we'll be making adjustments. But again, I think they've addressed things the right way by using the up cycles to be paying down debt, to modernize their fleet, to do those type of things when things are going real well, so that they're somewhat protected, but completely no one is.
Gotcha. The next up will be EuroDry. Do you think EuroDry is more interested in expanding its fleet or in returning proceeds to the shareholders?
Both energy and shipping companies historically operate on a expand the assets type of valuation. Management loves to talk about other assets, and they want to be a bigger company. I think that is fine and all. Certainly when we get into down cycles and the cost of adding new ships becomes much cheaper, we'd like to see that. But I think as you're entering into the cycle like we perhaps are now, that again, it probably makes more sense to shore up your balance sheet than it does to do either one of those two things that you mentioned.
All right, so next up, we have one that I guess would pertain to energy fuels, but more so the broad uranium market. Uranium prices have been poised to break out for years, but they haven't. Why do you think things are different now and going into 2023?
Yeah, well, we're hitting a couple key things. A couple major mines internationally are starting to dry up. Utilities have been recycling uranium, which can only go so far. There's even been some weapon grade uranium that they've been using. And again, those are all temporary situations. Most domestic producers of uranium, both in the United States or up in Canada, can produce probably in the $40 per pound. And we've been kind of stuck with uranium prices of around 40. Mainly because countries like Kazakhstan have very cheap production. But even there are some signs that production is starting to get a little bit more expensive. And of course, we've got some of the more global political tensions that have increased the desire to have the domestic production of uranium. There's even, there's been some some bills passed to create a strategic uranium reserve similar to the oil reserve. While we don't have all details on that yet, companies like Energy Fuels are in a good position to be one of those companies selling into the reserve.
All right, we'll close it with a pretty straightforward question on Permex Petroleum. And the question is, what does the company have to do to draw attention to the stock?
Yeah, that's a good question. When we talk about the value disparity we have with a company like this, the obvious question is, what can they do? I think part of the disparity stems from, some financing issues. They were going to do an equity offering in conjunction with an uplifting to the New York Stock Exchange, and they pulled that back as their stock price came down a little bit. As I mentioned earlier, it's really a case of showing that these assets in the ground can turn into cash flow. What they need to do is get things going. They need to get that first well starting to generate cash. They need to get the next one. Once that happens, now they'll have enough profitability and cash flow, I believe, as I've modeled out, that they can fund future drilling. It's going to be a slow get the ball rolling, and when it does get rolling, then I think things will really take off. But the key is really to get the first couple wells drilled and get some cash coming into the company.
All right, great. Well, that's all the time we have for today. Michael, thank you for the valuable information today.
Oh, my pleasure.